Okay, let's unpack this. Today, we're doing a deep dive into an institution that is, well, absolutely central to India's urban future, the Housing and Urban Development Corporation Limited, HUDCO.
That's right.
We've got their investor presentation and their full financial results for the first half of fiscal year 26, ending September 30th.
And our mission today really is simple: to give you the shortcut to understanding not just HUDCO's current financial health, but also its, let's say, ambitious strategic outlook.
Yeah.
This company is a vital operational arm in that whole vision of Viksit Bharat, and we need to figure out how they're balancing, growth, risk, and their very unique social mandate.
And that mandate is, I think, the key differentiator here, isn't it? HUDCO is a Navratna Central Public Sector Enterprise, a CPSE, and also a public financial institution, a PFI. They operate under this motto of profitability with social justice. And that tension, seeking profit while primarily serving social good, that's what makes this deep dive so fascinating, I think.
Exactly. Their core identity isn't just about lending money. It's really a three-pronged business model: financing, consultancy, and capacity building.
Right.
And that's across the entire infrastructure and housing space. They are the strategic partner for these huge national schemes. We're talking Pradhan Mantri Awas Yojana 2.0, Smart City Mission, AMRUT, Jal Jeevan Mission, Swachh Bharat.
All the big ones.
Yeah, they are embedded at the deepest level of national development.
And when you have that level of sort of embedded demand, it translates directly into velocity, doesn't it? H1 FY26 was clearly a period of, serious acceleration.
Definitely.
We saw their net profit climb by over 7.5%, hitting about 1,340 crore. But the real headline, for me anyway, is the revenue from operations.
Yes, that's the engine running hot there. We saw a stunning 30.81% surge in operational income. It jumped from roughly 4,700 crore to over 6,150 crore.
Wow.
That isn't just marginal growth. That indicates a massive increase in the flow of financing into the economy.
So just to put that 30% surge into context for you listening, imagine a company securing funding equivalent to launching, 10 to 15 major new state-level infrastructure projects, all in just 6 months.
Yeah, that's the kind of scale we're talking about.
That's the acceleration.
And that flow is reflected in the sheer size of their portfolio. HUDCO achieved its highest ever loan book figure this half year, 1,044,554 crore. That represents a pretty robust 30% growth.
That's truly massive. Can we break down where that money is actually going? Because social justice often makes you think housing first, but the numbers show the balance is maybe shifting a bit.
It is shifting, yeah. While the housing component is absolutely critical, the operational reality shows urban infrastructure is dominating now.
Okay.
So of that huge loan book, urban infrastructure projects account for nearly 65%, 64.89% to be precise. That leaves affordable housing at just over 35%.
Interesting split.
Yeah, and this split really shows the urgency the government places on upgrading urban systems, water, roads, connectivity, to actually support the housing they're also building.
Right, makes sense. So the machine is running fast. High operational income, 30% loan book growth, highest ever disbursements. But whenever money flows that quickly, the immediate question is always about risk.
Always.
For a typical commercial lender, a 30% loan book increase in just 6 months would, frankly, raise some red flags about asset quality.
Right.
How is HUDCO managing to maintain financial integrity?
Well, this is where the unique nature of HUDCO, that government backing, becomes immediately apparent. Their asset quality ratios are, frankly, spectacular.
Okay.
The gross NPA, or GNPA, dropped to just 1.21%, which is good. Very good. But look at the net NPA, the NNPA, which shows the actual exposure after they've set aside provisions. It's down to 0.07%.
0.07%. That sounds less like a financial ratio and more like a rounding error. Why are they even stating the ambition to reach zero NNPA? Is that target actually realistic, or is it just, aspirational PR?
It's realistic because of who their customers are. In commercial lending, 0.07% in NPA is basically unheard of. It means you're losing practically no money. And the foundation of this incredibly low-risk status is that sovereign guarantee context. An astonishing 98.71% of their entire loan book is loans to the government and its agencies.
Okay, so the core takeaway here is that HUDCO's low-risk status isn't really because they have some superior vetting process for individuals or private companies.
Not primarily.
It's due to a sovereign risk transfer mechanism. The risk is minimized because the borrower is fundamentally the state government, and the majority of these loans have explicit guarantees backing them up.
Precisely. Their risk profile is governmental, not commercial, in essence. And the security is also why they maintain such a strong financial footing for future expansion. Look at their capital to risk-weighted assets ratio, the CRAR.
Right.
It's impressively high at 38.03%. They are very strongly capitalized, and the stability is exactly why they hold the highest possible domestic credit rating of AAA from multiple rating agencies.
And that strong capitalization then directly enables their next move, which is fueling all that growth cheaply. So what are they doing on the borrowing side that's so clever?
Well, because they are seen as so secure, they can demand better borrowing rates. Their funding strategy is quite sophisticated, actually. They use varied sources to keep costs down.
Makes sense.
They raised over 32,000 crore in the half year alone. And crucially, they managed to decrease their overall incremental cost of borrowings to 7.12%. That's down from 7.45% in the previous comparable period.
That reduction is actually quite significant in this interest rate environment. That stability is paying for itself effectively.
It is. They utilized external commercial borrowings, for instance, raising 174 billion, which is nearly 8,000 crore, through international markets.
Okay.
And notably, they're also broadening their domestic retail base. They launched their first ever issue of the 54 EC capital gain bonds, raising over 28 crore just in Q2.
Interesting.
So yeah, they are actively managing their liabilities to really maximize the financial benefit of their low-risk profile.
Okay, let's pivot then. Let's move away from the rear-view mirror of performance to the windshield of strategy. HUDCO is traditionally, tethered to the government.
Very much so.
But they are clearly transforming their approach now to meet these massive infrastructure needs of Viksit Bharat. What do you see as the biggest strategic shift we need to watch?
I think the most monumental shift is this intentional opening up of their funding window to bridge the infrastructure gap using private capital.
Right.
The board has actually approved guidelines now to fund private sector projects in domains far outside their traditional housing and municipal mandate.
Like what?
We're talking about real estate, airports, energy, and roads. Seaport funding is also apparently under consideration.
That feels like a fundamental change in their operating mandate. I mean, if nearly 99% of their loan book is government guaranteed, and now they start funding private real estate developers or energy companies, is that sovereign shield being intentionally lowered to chase higher growth?
That is the central question about their future, I think. They're expanding into these sectors because, well, they're essential for economic growth, even if it introduces new risk elements they haven't traditionally dealt with.
Yeah.
But importantly, they aren't abandoning their core mandate, especially not at the grassroots level.
Okay, that brings us back to the focus on urban local bodies, the ULBs.
Yeah.
You mentioned capacity building earlier. HUDCO is putting significant effort into smaller municipalities, right?
Yeah.
Those with populations under 1 lakh.
Yes, that's a key area.
How exactly does HUDCO help a smaller ULB become bankable without just, handing them money? What does that capacity building actually look like on the ground?
It's often about fundamental financial hygiene, really. These smaller bodies, they frequently lack the internal expertise to develop projects that lenders would actually trust.
Right. They can't structure the deal properly.
Exactly. So HUDCO steps in as a consultant. They help them structure technically sound, financially viable projects. They are literally strengthening the financial capacity and the creditworthiness of these ULBs so that eventually they can stand on their own feet financially. And to help facilitate this, HUDCO was also notified as the credit guarantee fund manager for a 300 crore corpus. That helps de-risk smaller infrastructure investments, making them more attractive to other lenders too.
That's a powerful application of that consultancy prong of their business model. But if we look at the sheer scale of their future ambitions, the moves they signed this half year are truly breathtaking. It's almost hard to wrap your head around the numbers involved.
Oh, absolutely. The sheer size of the pipeline they've potentially created is historic. Just look at the agreement with the Mumbai Metropolitan Region Development Authority, MMRDA.
MMRDA, yeah.
That's a colossal MOU for financial assistance of 1.5 lakh crore over the next 5 years.
150,000 crores, just targeted specifically at the infrastructure of Mumbai's region alone. That's essentially a 5-year, multi-trillion rupee contract to reshape one of the world's largest urban areas.
It's massive. And that's just one state. They have separate MOUs with both the Madhya Pradesh government and the Rajasthan government, each committing 1 lakh crore for housing and infrastructure projects over 5 years.
Wow.
And on top of that, they're partnering with NBCC to jointly develop HUDCO's own existing properties, basically monetizing real estate assets they already hold. The scale of this transformation agenda is just undeniable.
Okay. Now, before we wrap up, we absolutely must apply our critical lens and look at the fine print, since we're reviewing unaudited financial results here.
Always important.
Let's talk about the specific disclosures made by the statutory auditors, SERC and Associates. Sometimes the most important insights are buried in those technical footnotes.
Absolutely. The first point that jumps out is actually a governance flag. The auditors drew attention to non-compliance with SEBI regulations regarding the required number of independent directors on the board. And this was flagged for two quite lengthy specific periods, a 3.5-year period from mid-2019 to the end of 2022, and then again from April 2023 right up to September 2025, the end of this reporting period.
So it's a recurring procedural issue that external watchdogs have noted.
It seems so, yes. A compliance point.
And then there was the mention of the no lien AGP account.
This sounds highly technical. Can you sort of simplify the fundamental issue with that deficit for us?
Sure. AGP refers to the Andrews Gange project. Basically, HUDCO acted as an agent, or like a clearing entity, for the Ministry of Housing and Urban Affairs, MOUA, on certain transactions related to this specific project some time ago.
Okay.
The account now shows a deficit, which is noted as recoverable, of 670.85 crore. So simply put, HUDCO is currently holding a debt that isn't technically theirs.
Right.
And they're in discussions with MOUA for the recovery or reimbursement of that amount.
And the interesting nuance here is that while they were chasing the reimbursement of that 670 crore, they actually recognized interest income on that exact amount for the quarter, about 6.72 crore.
Yes, that's right.
It's perhaps a clever accounting move, but it does highlight a pretty significant outstanding item that the government itself seems to owe at HUDCO.
It certainly highlights the complexity that can arise when an institution is so deeply intertwined with government operations. It's probably more a risk of delay in getting the money back rather than a risk of actual default.
Fair point. So if we look at the final scorecard for H1 FY26, what's the summary takeaway for you, for the listener?
I think HUDCO is executing its mandate with pretty impressive financial efficacy right now. We saw those world-class asset quality numbers, the incredibly low GNPA and especially NPA figures, robust capitalization, that rapidly growing loan book we talked about, and demonstrably effective liability management, achieving a lower cost of funds even as markets move.
And reflecting that strong half-year performance, the board approved a second interim dividend of one per equity share. That's 10% on the face value. So clear, immediate value creation for stakeholders too. Which leads us nicely back to that final provocative thought we sort of established at the start. HUDCO's success historically has been defined by its mission and its near zero risk profile, right? Underpinned by lending almost exclusively to governments.
Yeah, that was the bedrock.
Now, the path forward seems clear. A strategic pivot into these new infrastructure sectors like real estate, energy, roads, mobilizing large-scale public and private capital.
Right.
So the question for you, the listener, to really consider is this. As HUDCO increasingly forays into private sector financing to chase growth and help achieve the goals of Viksit Bharat, how will this inherently higher risk environment challenge or perhaps even reinforce its fundamental mission of achieving profitability with social justice over the next 5 years or so?